I'm Jessica Menton for IBTimes TV, and I'm joined by Jonathan Corpina from Meridian, who's going to weigh in about the Fed's latest Beige Book report and what this means for the U.S. economy. Thank you so much for joining me. It was good to see you again.
Thank you.
So the Fed released their Beige Book a little while ago, and they said that the U.S. economy is growing at a moderate pace. What does this mean compared to their last report?
Well, first of all, it's good to see that they released this information on time, as planned and as expected. So we were all waiting for maybe a little bit of a heads up, but watching the tape, it came out right as was. And basically what this is saying is something that we've kind of seen and read into all along, is that the economy is getting better, albeit it's at a very slow pace. And people are not too happy with the progress we've seen so far. But in fact, if you look at the numbers across the board, they have gotten better from where we were 4 or 5 years ago. So I think I think the message that's coming out of Washington on this is that they're keenly aware of the progress that's happening. There are other measures that can be injected into our economy to help speed things up. But it just seems right now at this point that staying on this pace, the Fed is quite comfortable with the tools that they have in place currently.
Now, the report was attributed to a rebound in housing. We did see the housing numbers yesterday. Housing starts jump, but permits were light. Should that cause some concern, seeing that permits were light because of the retail numbers last week and also those employment numbers? Should that cause concern later on in the year?
It could show some concern later on in the year, but I think looking at the housing numbers overall is a positive. I think it's showing that investors right now are comfortable with where the market is, where their incomes are, where they're spending their money, the ability to borrow money from banks. It seems like the housing market has gotten back on track to afford people the opportunities to get into the housing market. I think people, there was a fear factor that was there 2008, 2009, 2010. I think the fear of not accumulating enough wealth has passed, and I think people are a little bit more comfortable about where they are and more comfortable about making that big purchase of buying a home. So in the past, when we had many investors who were on the sidelines waiting for the right time to buy the home, and maybe it was the right time as far as prices were concerned, but just didn't have the ability to obtain money or felt comfortable in such a large commitment. I think now the commitment level is much higher than it was in the past, and if people feel comfortable buying homes, getting into it, and taking on that responsible debt.
And finally, you did mention buying homes. Right now, people are able to afford those mortgage rates because interest rates are so low. When interest rates do go back to normal, will that end up taking a toll on housing prices?
It's going to. I don't know if it's specifically on housing prices. I think it's just going to be more about one's ability to stay within their mortgage and where they're at right now. But Jessica, we've been having this conversation about interest rates and when are they going to move interest rates. It goes back 2.5 years. So having interest rates move in the opposite direction of which they have been moving, I don't even think is on anyone's radar screen at this point right now. Yes, we're going to have to face it, and yes, we're going to have to address it. But as of right now, there is no indications to me that I see that interest rates are going to move anytime in the short future.
Thank you so much for joining me.
Thank you.